Welcome to the deep dive. You've handed us, well, an incredible set of sources this time. Really, a true architectural blueprint of global success and power.
Mhm.
We have cutting-edge, deep learning tech sitting right alongside data on, centuries of income inequality.
Yeah, and tales of financial manipulation that literally span continents.
It's quite the mix.
It really is. It's a remarkable stack because I think the sources force us to look beyond any single explanation for wealth. Our mission today really is to synthesize these materials, to try and understand the anatomy of modern power.
Okay.
What drives that astronomical financial success? Where is that power accumulating globally? And crucially, what rule sets, both the brand new ones and the really old ones, are defining today's elite?
So we're essentially hunting for leverage, right?
Mhm.
How do these brand new frontiers, things like massive data pools and artificial intelligence, how do they create wealth so quickly?
Right.
And then the flip side, how do older forces, more ingrained things like strategic political connections, complex financial engineering, how do they make sure that wealth concentrates?
And often produces these radically different economic landscapes, comparing New York to Shanghai to, say, Jakarta.
Exactly. So we need to identify the systems, the mechanisms that allow a few individuals or companies or maybe even states to capture these really outsized returns.
Yeah, whether those systems are like technological innovations that accidentally or purposefully create monopolies, or maybe institutional failures that just permit wealth extraction. It's a complex picture.
Okay, let's begin where the velocity seems highest right now, which is technology. When we dive into the sources on the current AI boom, there's a really crucial insight we need to establish right up front.
Mm.
The current boom isn't really driven by rapid progress toward a true sentient general AI. That's not what's happening economically speaking.
No, exactly. Instead, we are firmly in what the sources are calling the age of implementation. The age of implementation. Explain that. Well, that distinction is key, I think, to understanding the economic engine right now. The really profound foundational technological leap that was deep learning. The ability of algorithms to find patterns in just massive data sets. That already happened maybe, a decade ago?
Right, the breakthroughs were earlier.
Yeah, so the wealth generation today, it comes from the lower risk but highly profitable application of that existing power.
So we've sort of crossed the big innovation chasm, and now it's about commercially exploiting the tech we already have. Why is this implementation phase so economically effective?
Well, it's immediate and it's targeted. We're talking about applying deep learning's power, that pattern recognition, the prediction to specific, pretty narrow spheres.
Okay.
It's not trying to solve philosophy, right? It's optimizing logistics. Think about predicting maintenance failures in a supply chain before they happen.
Huge savings there.
Huge. Or diagnosing disease from millions of x-rays in seconds. Automating underwriting for specialized insurance. Providing instantaneous, context-aware translation.
These are all things happening now.
Exactly. And they offer immediate ROI, return on investment, by optimizing these big legacy systems. And that's far more bankable, far more certain than, waiting around for artificial general intelligence.
And if implementation is the key phase, then data is the absolutely indispensable natural resource for it.
Totally.
Our sources point to this really seismic shift in global data production, particularly when we look at China.
Yeah, they argue pretty compellingly, I think, that China has already surpassed the United States as the #1 producer of data, just in terms of sheer volume.
Wow.
And this isn't just trivia, right? It's positioned as the critical advantage in this AI race. Because these deep learning models, they're only as good as the volume, and importantly, the quality of the specific data they're trained on.
And China's ecosystem facilitates that.
Well, yeah, their unique ecosystem apparently facilitates just an astronomical harvest of that specific usable data.
What makes that ecosystem so unique then? The sources suggest there was this divergence, maybe around a decade ago. Historically, analysts in the West would try to understand Chinese tech by finding analogs.
Right, the Facebook of China, the Google of China, that kind of thing.
Exactly. But the sources explain that around 2013, something changed. China's internet took, quote, a right turn.
Yeah, it started developing products and services that, simply had no analog in Silicon Valley.
Why? What drove that?
It seems to be partly driven by just the massive mobile adoption rate there, plus the lack of existing legacy infrastructure. I mean, think about it. They could sort of leapfrog straight to mobile first.
So skipping the desktop era in many ways.
Pretty much, and developing these consolidated super apps that combine social media, payments, services, all in ways that were just unfamiliar to the average U.S. consumer at the time.
And a perfect example of this kind of explosive, practical, real-world innovation is the bike-sharing startups. Mobike, Afuga.
Oh, yeah, that's a great case study. This is logistics and AI really in action, but on a massive physical scale.
Explain the scale.
Well, think about the logistical marvel involved. These companies, they flooded major Chinese cities, distributing literally tens of millions of internet-connected bicycles.
Tens of millions.
Yeah, so a user finds one on an app, scans a QR code, probably using a mini app inside WeChat or Alipay.
Right, those super apps.
Exactly. The smart lock opens, they ride it, and then they just leave it anywhere for the next user. The entire operational footprint, tracking the bikes, redistributing them, maintenance, it's all data-driven.
And it wasn't just tech. It was an economic revolution on the streets, wasn't it? Heavy subsidies, incredible efficiency. The cost was often, what, 15 cents or less per ride?
Yeah, incredibly cheap.
Yeah.
And what allowed that specific innovation to flourish in China, maybe more so than in the U.S. initially?
The sources are really clear on this.
Mobile payments?
Absolutely. The ubiquity of mobile payments was the linchpin. I mean, imagine if Mobike had tried to integrate traditional Western credit card point-of-sale machines onto every single bike.
The cost would have been insane. Hardware, transaction fees, maintenance.
It would have crushed the economics completely. But that consolidated, cheap, seamless mobile payment environment, the WeChat ecosystem, it enabled an innovation that was otherwise just logistically impossible, or at least prohibitively expensive.
So that integrated ecosystem, that's a key source of Chinese leverage in this implementation age.
But, this scale of innovation, it isn't purely the result of free market genius operating in a vacuum. We also see clear evidence of direct state involvement.
State-sponsored entrepreneurship.
Yeah, the mass innovation campaign in China. It didn't just passively encourage tech. It seems like it actively subsidized entrepreneurs and really shifted the cultural zeitgeist towards risk-taking.
And this was structural, right? Not just incidental funding here and there. The State Council issued this massive directive calling for thousands of technology incubators, entrepreneurship zones.
And crucially, they set up these government-backed guiding funds.
Talk about those. What were they?
Well, they weren't traditional grants. They were designed specifically to attract and, importantly, de-risk private venture capital investment. They offered preferential co-investment terms.
So the state acts like a huge anchor investor.
Exactly. Leveraging private capital, but directing it towards state-defined strategic goals. Plus, offering preferential tax policies, streamlining permits, all to accelerate business growth.
It's a very top-down innovation push, something the American system doesn't really replicate in the same way.
And that state sponsorship, it flows directly into what might be the highest stakes geopolitical race right now. The pursuit of next-generation AI hardware. Chips.
Right. These advanced chips are the foundation for everything. Self-driving cars, supercomputing, military applications, you name it.
And for decades, making high-performance chips was dominated by just a few specialized firms, mostly in Silicon Valley or, Taiwan, South Korea. It's incredibly complex, expertise-intensive stuff.
Yeah, absolutely.
So why are the sources now noting that, quote, much of the action in this space is taking place in China for the first time?
Because control over the hardware is seen as absolutely fundamental to controlling the AI future. Simple as that.
Makes sense.
And while, Chinese state-sponsored projects in chip manufacturing have definitely struggled in the past, issues with execution, maybe corruption.
Right, it wasn't always successful.
No, but the sheer intensity now, the concentration of resources being poured into building indigenous chip capabilities, it reflects a massive national priority. They know that without mastering complex lithography, chip architecture, they just remain dependent on external suppliers for the engine of their new economy.
So it's a massive directed challenge to the existing technological hierarchy. Okay, so we've laid out this new frontier of wealth creation data, implementation, state direction. Now we have to kind of zoom out and look at how wealth, both the new stuff and the old inherited kind, how it concentrates globally, which brings us squarely into the structures of modern inequality.
Right. And the starting point here has to be challenging that old economic assumption, the one taught in basically every introductory textbook.
A stable split, labor versus capital.
Exactly. That idea that the national income splits roughly 2/3 for labor, 1/3 for capital, and that this is stable over the long run.
Yeah, I remember that from Econ 101.
We all do. But that assumption, which was, a comforting backdrop for a lot of 20th century economic modeling, it's now viewed by the researchers in our sources as, quote, quite a bit more complex, maybe even outright flawed by the new data.
Okay, so what does the new data show, specifically for the U.S.?
Well, looking at the U.S. trajectory, the numbers are pretty jarring. Income inequality in the 2000s didn't just increase a bit. It actually regained the record levels previously seen almost a century earlier.
You mean like the 1910s, 1920s?
Exactly. We're talking Gilded Age levels of concentration returning.
Wow. But is it the same kind of concentration? The sources suggest the composition of that top-end income is fundamentally different today.
That's a vital distinction, absolutely. If you look at the top 0.1% back in, say, 1929, that wealth was overwhelmingly driven by inherited capital income, rent, dividends, interest.
Old money.
Pretty much. But today, the sources show a much, much larger role played by very high incomes derived from labor, earned income, essentially.
Okay, and this is often used to justify the current structure, isn't it?
Very much so. High income inequality today is frequently characterized, especially by its beneficiaries, as the natural outcome of a hyper-meritocratic society.
Or a society of superstars.
Right. The implication being that the wealth is earned through unique, irreplaceable skill, not just inherited privilege. It's merit-based, supposedly.
But who are these so-called superstars? Because the data is fascinating here. It kind of dispels the easy narrative of, celebrity wealth driving inequality.
Yeah, that's a common misconception. In the top 0.1% income group, athletes, actors, artists, collectively, they make up less than 5% of that group.
Less than 5%. So it's not Hollywood or the NBA primarily.
No. The sources state very clearly that the new inequality has much more to do with the advent of supermanagers.
Supermanagers. Okay, define that term.
This is a critical distinction. Now, financial professionals are definitely heavily represented. They're about twice as common in that top 0.1% group as they are in the overall economy, maybe making up roughly 20% of the total.
So Wall Street plays a role.
A significant role, yes. But the core driver of the increase in inequality isn't just finance. It's the skyrocketing pay of top managers in both financial and, importantly, non-financial sectors.
So CEOs of regular companies, too.
CEOs, senior executives, hedge fund principals, yes. Their labor income, often heavily inflated by stock options, performance bonuses, is just disproportionately high relative to, standard compensation patterns lower down.
Why? Why are these supermanagers able to command such incredibly high incomes? Is it purely market forces?
Well, the sources suggest it often comes down more to institutional shifts and issues in corporate governance, maybe boards that lack independence or they rely on flawed benchmarking against other highly paid CEOs.
So it's self-reinforcing.
It can be. They fail to rein in executive pay effectively. And this creates this very specific kind of wealth concentration that's tied not just to pure market skill, but also to these institutional structures that reward the very, very top of the corporate ladder, arguably excessively.
And the proof that it's institutional, or at least partly institutional, comes when you compare internationally.
Exactly. That's where it gets really telling. You put the American experience into a global context, the US, the UK, other Anglo-Saxon countries. They've seen this steep, dramatic increase in inequality since the 70s and 80s.
Right.
But then you look across the Atlantic, continental Europe, France, Germany, Sweden, or you look across the Pacific to Japan.
And the story is different.
Completely different. In those countries, income inequality today is still far lower than it was back at the beginning of the 20th century. And crucially, the sources note that concentration has not changed much since 1945.
Wow, stable since World War II, basically.
Pretty much, which strongly implies that those hyper-meritocratic market forces, or whatever you want to call them, that seem so powerful in the U.S., well, they aren't inevitable laws of nature. They're mediated by policy choices.
Like what kind of policies?
Continental Europe and Japan, they generally retained stronger unions, national wage bargaining systems, higher top marginal tax rates, sometimes wealth taxes after World War II. And these acted as institutional buffers against the extreme concentration of wealth we see today in the U.S. and the U.K.
Okay, so that's income. But beyond income, we also see these big structural transformations in wealth itself, the actual assets people own.
Yes. And the most important long-term change identified in our sources isn't just the rise of the super-rich top 0.1%. It's also the emergence of what they call the patrimonial middle class.
Patrimonial middle class. Interesting term.
It's a fascinating intermediate group. They're distinctly wealthier than the poorer half of the population, right? And collectively, they own maybe between a quarter and a third of total national wealth.
And what makes them patrimonial?
They rely heavily on inherited assets, usually things like real estate, retirement funds passed down to maintain and grow their status. It reinforces this idea that wealth accumulation is increasingly determined not just by your own labor, but by the assets you inherit. It's a clear sign of a growing patrimonial society where inheritance matters more and more.
Which brings us to a small but I think important footnote the sources make about inflation. People often worry, inflation eats away at my wealth.
Right, the universal fear.
But the sources give a much more nuanced view. They clarify who actually suffers the so-called inflation tax.
Yeah, it's not everybody equally. Inflation is really only a tax on the idle rich, or maybe just the idle, period. People who hold substantial amounts of uninvested cash, banknotes under the mattress, that kind of thing.
But if you're part of that patrimonial middle class you just described, or a big institution like a university endowment,
If you invest your wealth in real assets, real estate, stocks, commodities, whatever, you largely escape the inflation tax entirely.
because those asset prices tend to rise with inflation.
Or even faster sometimes, meaning you can still get very high real returns after accounting for inflation. And this detail just underscores how sophisticated asset management provides this immense protection against what people assume is universal wealth erosion. It just compounds the advantage for those who already possess capital and know how to manage it.
Okay, we've covered the new frontiers of tech. We've looked at the American supermanager and inequality structures.
Yeah.
Now, to really map global power, we need to look at empires built differently. Not necessarily on hyperrationality or deep learning, but maybe through political and geographical leverage.
Exactly. Which takes us to some of the alternate paths to riches found, particularly in Asia.
And the sources kick this section off by defining city-states like Hong Kong and Singapore. They call them archetypal port city-states.
Yeah, and their success is built on a very simple yet really profound economic trick. They basically arbitrage the relative economic inefficiency and often the political instability of their massive hinterlands. Mainland China, Southeast Asia.
Arbitrage how? What's the trick?
It involves offering two key things above all else. One, tariff-free trade, making them efficient hubs for goods. And two, an incredibly stable, convenient place to park money.
A safe haven for capital.
Precisely. And the key to their business model, as the sources really highlight, is that historically they asked, quote, few or no questions about what is being traded, or, crucially, where the money came from.
So institutional neutrality, or maybe opacity.
Call it what you will, that's their core offering. It attracts capital that might be fleeing unstable regimes, high taxes, or maybe just overly regulated economies next door.
Okay, so that's the city-state model. Moving beyond that, we see cronyism operating at the national level in some places. Indonesia in the 1960s is a key example from the sources.
Yeah, following the political chaos then, Suharto seized control, and he deliberately turned to a very specific group of businessmen to help build his economic base.
Not just any businessman, though.
No. He consciously relied on, quote, unthreatening ethnic Chinese outsiders. Figures like Liam Seo Lim, Mohammed Babasan are mentioned.
And why them? The sources suggest a kind of political cynicism was at play.
Deep cynicism. Suharto reportedly complained that pribumi, that is, indigenous Indonesian businessmen, couldn't be trusted.
Why not?
He apparently preferred ethnic outsiders because they lacked a strong, independent political base within the dominant Javanese political structure. That made them wholly dependent on him for protection and for their continued success. Their loyalty was guaranteed by their vulnerability.
So it's a clear case where political leverage just completely trumped pure market efficiency. I mean, these businessmen were effective, sure, but their power came directly from their calculated loyalty to the ruler, not necessarily from winning in the open market.
Exactly. Their primary customer, in a sense, was the state or the person controlling it.
Malaysia provides another pretty stark example, right, with Syed Mokhtar al-Bukhari.
Yeah, he became Prime Minister Mahathir's, quote, chosen one. And he was granted these massive concessions, including essential national assets like power generation, container facilities.
And the sources make it clear this wasn't just luck or business genius. He apparently mastered how to, quote, press the premier's buttons.
Right. And what were those buttons? The sources offer this really telling anecdote. Syed Mokhtar built this magnificent Islamic art center in Kuala Lumpur, high domes, marble, the works. Apparently, Mahathir frequently checked on its progress.
Strategic flattery, basically.
It seems like it. That kind of thing, combined with political alignment, resulted in the transfer of these hugely valuable long-term state concessions. And then The sources detail how Syed Mukhtar took these capital-intensive assets, moved them from his private companies to his publicly listed vehicles at inflated prices.
Effectively cashing out?
Yeah, stripping cash out of these government-granted utilities for his private gain. It's a classic crony capitalist playbook.
What's fascinating about these tycoons, though, is the narrative they often craft for themselves afterwards. Many of these Asian godfathers, they really push this monocultural rags-to-riches story.
Oh, definitely. The sources call it a kind of double self-deception, meaning they often come to believe their own hyper-individualistic success story, and they feed that simple, reassuring narrative to a public that's often eager for proof that pure merit, not connections, can win.
But the reality is usually more complex.
Much more complex. When you actually dig into their backgrounds, as the sources do, only about a fifth of these tycoons could truly be described as self-made from scratch.
Really? Only 20%.
Roughly. In reality, they were often, quote, better educated than popularly believed. And they usually already possess some practical advantages within their peer group, maybe family connections, some starting capital, regional trade expertise. It was rarely a true zero-to-hero story, despite the mythology.
Okay, and finally in this section, we look at the modern China model of wealth creation. How does that compare, say, to the Russian oligarch path in the 90s?
It contrasts pretty sharply. The Chinese red oligarchs, as the sources sometimes term them, they didn't primarily get rich from a single chaotic sell-off of natural resources like oil or metals, the way many Russian oligarchs did.
So how did they build their wealth?
Their prosperity is built on privileged access to the two absolutely essential economic goods that the Chinese state still comprehensively controls: land and capital.
Okay, explain that.
Well, land use is still very tightly governed by the state. And critically, over 90% of all loans in the country are still made by state-controlled banks.
So getting access to capital, getting a big loan.
It requires a favorable political relationship. It's fundamentally a political decision, often not purely a financial one, based on risk and return assessed independently.
Which ensures the state maintains ultimate control.
Exactly. And it means the path to becoming a major oligarch in China is largely defined by your political alignment and your access to the people who control the levers of credit. It just reinforces the absolute centrality of the state in any major wealth creation story there.
Okay, shifting gears again. We move from that kind of geopolitical access model to the sheer velocity and sometimes the sheer obsession that defines modern finance and corporate management. Let's start with Wall Street and the almost absurd lengths high-frequency traders HFTs go to in pursuit of what the sources call micromoney.
Yeah, the sources detail an extremism here that almost defies rational explanation until you understand the scale and speed involved. I mean, traders are spending hundreds of thousands of dollars just to move their hardware cabinets a few feet closer to the exchange's servers.
Physically closer.
Physically closer. They measure the fiber optic cable lengths inside the data centers, quote, to the foot.
Incredible. And what are they actually chasing with all this effort? How much speed are we talking about?
Tiny amounts. The speed difference between a fast data switch and a slow one has apparently fallen from maybe 150 microseconds down to just 1.2 microseconds per trade.
1.2 microseconds. That's millionths of a second.
Exactly. And the observation from one source just perfectly captures the madness. Never before in human history have people gone to so much trouble and spent so much money to gain so little speed.
Yet in HFT, that tiny advantage is everything.
It's everything. That 1.2 microsecond advantage, it allows these firms to see prices or see order flows just fractions of a second before their competitors. And in a game of speed, that's enough.
But it's not just raw speed, is it? It's also about intelligence, how they use that speed.
Right. It's weaponized intelligence. And one particularly fascinating tactic the HFT firms use, according to the sources, they intentionally place small, loss-making stock market orders.
Why would they place orders designed to lose money?
They aren't meant to trade profitably. They're probes, like sending out sonar pings. By placing these tiny orders and then canceling them incredibly rapidly, they glean information about the true market depth, the hidden orders, the intentions of other, slower investors.
Ah, so they sacrifice tiny amounts of money on these probe trades.
To gain vital intelligence, information asymmetry, which then allows them to place much bigger, genuinely profitable orders just seconds or milliseconds later, making up for those initial small losses many, many times over.
It's calculated manipulation of information flow, really, enabled by this ultra-low latency tech.
It absolutely is, and that kind of weaponized speed Maybe it leads us conceptually to a classic example of weaponized deceit, the older, more manual form of financial manipulation, thinking about Michael Milken and his junk bond empire.
Right. The sources explain Milken's pattern of, quote, calculated fraud, deceit, and corruption.
Yeah, and his scheme involving Ivan Bojeski is just a textbook example of intentionally creating fictitious market dynamics to benefit himself.
Break down that specific transaction cycle. It was quite complex.
It was layered. Milken would first buy back securities, often junk bonds, at artificially low prices from certain Drexel clients. These clients were often unaware of the true market value or even who was really buying. He would then sell those same securities to Bojeski, the famous arbitrager, at a small profit. Then Bojeski would in turn resell them back to Drexel, Milken's firm, but at a much higher price.
Inflating the price artificially.
Exactly. And then Drexel, directed by Milken, would resell those now overpriced securities to other Drexel clients at still higher prices.
So shuffling assets between controlled parties to manipulate price, what was the ultimate goal?
It was complex, but specific. Part of this cycle was designed to secretly repay millions of dollars that Milken apparently owed Bojeski from previous illicit deals, but it also simultaneously allowed Milken's trading operation at Drexel to continue booking massive profits by controlling the flow and pricing across multiple, seemingly independent parties.
And the victims were.
Ultimately, Drexel's unsuspecting clients on both ends of the trades, and really the integrity of the market itself. Prosecutors didn't just call it insider trading. They described it as a systematic master scheme to acquire power and accumulate wealth through intentional market distortion.
This hunger for control, whether it's through microsecond speed or calculated market fraud, it transitions pretty neatly into the intense, sometimes obsessive corporate cultures established by really iconic founders. Let's look at two giants mentioned, Jeff Bezos and Steve Jobs.
Right. Bezos is described as embodying this unique form of hyper-rationality. His primary obsession, according to the sources, is the company's performance, customer service. Everything else, including personnel issues, employee well-being even, is viewed as secondary.
And the sources suggest this isn't an act.
Some employees apparently theorize it stems from a genuine lack of operational empathy, which paradoxically allows him to be incredibly cold-blooded and effective in allocating capital and human resources. Just pure logic.
The sources quote that he doesn't tolerate stupidity, even accidental stupidity.
Yeah, reflecting a kind of zero-tolerance culture for anything seen as inefficient. The cost of this hyper-rationality can be high for individuals, maybe, but the benefit is this ruthlessly optimized machine built purely for growth and scale.
And Jobs, by contrast, he operated differently.
Very differently. More through sheer charisma and force of will. He was famously known for his reality distortion field.
Explain that.
It was Jobs' uncanny ability to impart such intense confidence and certainty that he could push engineers, designers, anyone to do things they previously thought were completely impossible.
There's that anecdote about the car.
Yeah, the sources recount him making someone drive his Ford Ranchero at 55 miles per hour before they even really knew how to operate a stick shift, simply by projecting this total certainty that they could do it. And somehow they did. That intensity was apparently essential to Apple's breakthroughs.
And his obsession extended to every tiny detail, right? Down to the packaging.
Oh, yeah. The tactile experience of opening the product packaging, Jobs believed that set the tone for how you perceive the product. But his obsession wasn't just aesthetic, it was also functional. He forced engineering brilliance, like pushing for Rod Holt's revolutionary switching power supply for the Apple II.
Which Jobs claimed was as revolutionary as the computer's logic board itself.
And he was probably right. So in both cases, Bezos's cold calculus, Jobs' passionate obsession, you see the founder's singular, immense leverage dictating the entire culture and the output of the company.
Okay, and finally, we see maybe the culmination, or perhaps a distortion, of this founder leverage idea in the startup delusion era, epitomized by WeWork under Adam Neumann.
Ah, WeWork. Yeah, this highlights how modern venture capital, particularly in the late 2010s, sometimes seemed to prioritize rapid, maybe even irrational growth and definitely charismatic vision over traditional business economics.
Neumann offered these really unusual, distinctly non-financial justifications for WeWork's absolutely stratospheric valuation, didn't he?
He really did. He explicitly claimed its valuation was, quote, much more based on our energy and spirituality than it is on a multiple of revenue.
Energy and spirituality driving a multi-billion-dollar valuation.
That's the reality distortion field applied directly to a balance sheet, essentially.
But despite all the high-flown rhetoric about community and changing the world,
The company's financial reality was utterly grounded and, frankly, pretty grim. Its numbers still looked exactly like those of a traditional real estate company. It generated nearly all its revenue from office rentals, which they just optimistically rebranded as membership fees.
And it was losing staggering amounts of money.
Hemorrhaging money as it plowed investor cash into just breakneck global expansion, all operating on this faith that scale alone would somehow, someday, translate into profit.
And the ultimate sign, maybe, of that founder leverage and the prioritization of personal wealth over, say, fiduciary responsibility to investors was the cash withdrawal Neumann made.
Yeah, that was remarkable. Despite the increasingly murky business model, the company's eventual dramatic implosion right before its planned IPO. Newman's personal entity, We Holdings, had already sold nearly $500 million worth of shares before the public offering was even attempted.
$500 million.
$500 million. That payout represents one of the largest amounts ever withdrawn by a U.S. startup CEO pre-IPO. It just perfectly demonstrates the immense structural leverage founders could possess in that funding environment. While the company was still struggling to convince the market of its spiritual valuation, the founder had already guaranteed his own massive personal financial security, whatever happened next for the investors or the employees.
Wow. We have journeyed through an absolutely extraordinary landscape of power in this deep dive. I mean, we've seen immense wealth built on this age of implementation, these massive data pools in China.
Contrasted with the huge labor income captured by the American supermanager.
Then we explored financial success achieved through, well, pure political cronyism in parts of Southeast Asia, and the frantic, almost microscopic manipulation of speed in high-frequency trading.
And the common thread, I think, running across all these different models is this relentless search for leverage.
Leverage, yeah.
Whether it's leverage through information asymmetry like the HFTs, or political connection like the Asian Godfathers, or optimized data like in China, or just sheer charismatic force applied to capital allocation like Jobs or Bezos.
And putting it all together, this synthesis reveals this really critical contrast, doesn't it? It sort of defines our era.
I think so. On one hand, you see this unprecedented, incredibly rapid innovation, AI implementation getting better all the time, complex hardware design pushing boundaries, microsecond trading efficiency.
Amazing technological progress.
Absolutely. But on the other hand, that innovation coexists with these deeply entrenched, often really opaque systems for wealth extraction and concentration.
Like the institutional factors that protect wealth differently in Europe versus the U.S.
Exactly. Or the calculated fraud of a Milken, or the deliberate political access required to get ahead in other systems.
So the new world of tech hasn't necessarily flattened the old hierarchies of wealth.
No, it seems like instead it often provides new, hyper-efficient tools to exploit the existing structural inequalities. We've seen how power is built today through data, through speed, through political access.
Which brings us to maybe the final provocative thought for you, our listener, to take away from all this. If we accept the argument that the global structures of inequality are increasingly defined by this super manager figure, earning massive labor income, not just old inherited capital, does that make today's extreme wealth concentration more defensible?
Or is it perhaps even more insidious, more dangerous than the old wealth structures that were built more purely on inherited capital? Does calling it hyper-meritocratic, implying it's earned through unique talent and hard work, make us less likely to question it?
What is the ethical cost of a society that produces these outcomes, even if we label it meritocratic?
The structures may have changed, the justifications may have shifted, but the concentration remains stark. And analyzing the specific mechanisms, whether it's data flows in Shenzhen, or supermanager compensation structures, or Milken's layered transactions, that's really the first step toward understanding the ethical cost and the true anatomy of modern power.
And that's the deep dive. Thank you for joining us.